Welcome to another edition of Taking Stock for the week ending the 28th of March, 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to all things share market. Thanks for joining us today, Matt. Hope you are well.
I am Kien. It's good to be joining you again.
Great to have you on board again. But just before we get started, a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, the US and Australian share market, they continued their recovery early in the week, and that was helped by reports that the US is adopting a more targeted approach to their tariffs. Additionally, we saw the Federal Reserve hint at the possibility of further interest rate cuts in response to signs of an economic slowdown. While in Australia, though, a similar narrative is unfolding as lower than expected February inflation data reinforce expectations that the RBA may move to cut rates sooner than anticipated.
I'm sure all mortgage holders are awaiting some further rate cuts and some relief can. And the core inflation rate did fall to 2.7% in February from 2.8 in January, and now it's well within the RBA's target band of about 2 to 3%. However, the market is still not expecting the RBA to drop its cash rate again until July, which was well after the federal election.
Yeah, the federal election date has now been announced, and it tends to cause a bit of volatility in markets during this time. But another theme that emerged this week was the increase in M&A activity within the Australian market. We saw bargain retailer, The Reject Shop. They received a takeover bid from Canadian value retailer Dollarama. Additionally, we also saw the ACCC approve Vocus's acquisition of TPG Telecom's fibre and fixed infrastructure assets. And of course, among our star stocks, we had building materials company James Hardie. They announced a 14 billion cash and stock acquisition of US-based AZEK. They paid a 37% premium to its share price, but we'll speak more about this later on in the episode.
Yeah, it was certainly an eye-watering number that Hardy's put up there for that acquisition can. And on this acquisition trail, there's more in the gold sector, and we've seen a huge surge in activity lately with South African miner Goldfields making a bid to acquire borderline star stock Gold Road in a variable cash bid estimated to be about $3.05 per share. Now, Goldfields is the operating joint venture partner with Gold Road in their lucrative Gruyere gold mine.
Yeah, quite an interesting one, Matt. I mean, while the two companies have collaborated since 2016, recent events suggest a divergence in strategic priorities and value expectations. Gold Road's board described the bid as highly opportunistic and significantly undervaluing the company, while analysts, though, they viewed the bid as attractive with institutional investors. They are now pressuring Gold Road's board to reconsider.
And rather than accept the offer, Gold Road countered with its own bid to acquire Goldfields' stake in Gruyere, an offer which was ultimately declined. And complicating things a little further, Cam, Gold Road holds a 17% stake in De Grey Mining, which is currently the subject of a takeover from Northern Star Resources. So should Gold Road choose to sell its De Grey stake to fund its Gruyere acquisition, it could disrupt the dynamics of the Northern Star's proposed takeover.
Yes, so many moving parts there, Matt, but very interesting nonetheless. This flurry of deal making reflects a broader consolidation trend in the gold sector. Only a few weeks ago, we saw Ramelius Resources. They acquired the financially unhealthy miner Spartan, and this led to its removal as a star growth stock. There is now speculation that Genesis Minerals, that's our star growth stock, could have a play for Vault Resources as well. And analysts believe this could occur later down the track, with Genesis focusing on mill expansion at this stage. Moving now from the gold sector to retail, former star stock, Premier Investments, they reported this week, but revealed a decline in their return on equity and profit margins. And the stock has been under some pressure, with the business having divested its apparel segment to Myer and now operates with only the stationery Smiggle and sleepwear Peter Alexander brands.
Yes, the refreshed and new look Premier Investments maiden result followed this divestment, and we looked at it as a mixed bag of sorts. Although the earnings were in line with guidance provided by management in January, the stationery brand Smiggle was a large disappointment with sales down about 14.5% year over year. The company is undergoing a review of its existing loyalty program, but meanwhile, the sleepwear division, Peter Alexander, fared much better with sales up 6.6% on year with store rollouts ahead of expectations.
Yeah, very interesting dynamics at play there. But looking at Stock Doctor, we can see the impact of the divestment and how it has on the financials. Analysts have downgraded their earnings expectations on the back of this demerger and also the tougher retail environment as well. And this is reflected in the near 50% decline in revenue growth for this year. However, consensus does expect earnings growth to return in financial year 26, and that's driven by store openings and also this UK market expansion as well. But despite this, given its declining profit margins, its return on equity below our thresholds, negative earnings revisions, and uncertainty surrounding the CEO transition, we are adopting a cautious stance on this stock. We prefer to stay on the sidelines until the full financials for the demerged businesses are released. Now, for Under the Microscope this week, we take a closer look at James Hardie. For those who aren't familiar with the company, they are a global leader in fiber cement building products, and that's widely used in residential and commercial construction. The company is listed both here in Australia and the US, and over the years, they've built a very strong footprint in the North American housing market.
Yeah, that's right, Kien. And it is the US exposure that's in focus this week with the announcement to acquire AZEK for a massive 8.75 billion US dollars, or approximately 50% of the company's market capitalization. So this is a big deal, both literally and figuratively.
Yes, certainly a big acquisition there, Matt. But the aim here appears quite strategic. James Hardie is looking to create a one-stop platform for exterior home products by combining their core fiber cement offerings with AZEK's composite decking, railing, and exterior trims. They're going after a much larger share of the outdoor living space market in North America.
Yeah, and that space is seeing solid growth in the face of changing consumer preferences. More people are investing in their homes, especially in outdoor living. So in theory, we think the move makes strategic sense.
Yeah, that trend does appear to be happening here in Australia as well. But a lot of eyebrows were raised at the price tag, though. James Hardie is paying a 27% premium to AZEK's 30-day average price. From a valuation multiple perspective, though, it looks quite expensive at around 22 times versus an industry average of around 14 times at this stage. So overpaying for businesses can lead to significant write-downs down the track and also potentially dilute the profitability of James Hardie, which is expected to generate quite a high return on equity multiple in excess of 30% over the next 2 years.
And hence the market wasn't thrilled. Shares in James Hardie did drop on the day about 15% after the announcement, and that kind of reaction does tell you there are some real concerns about this deal.
Certainly, the market is worried here, and credit rating agency Fitch has already revised James Hardie's credit rating outlook to negative, pointing to increased debt levels. That's because a large part of the transaction is being funded through borrowings, and this could potentially impact its financial health and profitability metrics, which has been quite strong. So what does this mean for its profits going forward, Matt?
Yeah, that's the golden question, isn't it, Kien? And management have provided some guidance around this, and they think that the deal could generate about $350 million in synergies. That'll be some cost savings plus these obvious cross-selling opportunities, which should boost its revenue by 2.5% and underlying earnings or EBITDA by 3%. Plus, they expect the deal to be accretive to cash EPS within the first full fiscal year post-acquisition.
Yeah, there are certainly some big assumptions here, isn't there? And we certainly don't like acquisitions that are just too large, especially when you're paying quite a significant amount for these acquisitions. But given the size of the deal, the premium price that was paid, and also increased debt levels, we have decided to err on the side of caution and remove the stock from our coverage list until we have more confidence on the outlook and how this deal will play out. And following on from the flurry of M&A activity within the gold space and also James Hardie's bid for AZEK, a useful question for investors this week is how can one assess the impact and risks of an acquisition?
It's a great question, Ken. And acquisitions can be transformative for companies, offering opportunities to build scale and market share to fend off competition, expand its geographic footprint into new jurisdictions, and reduce reliance on a single market, can create synergies, and the acquiring company can even acquire new technologies or skilled people. However, there are risks that investors should look out for.
Yeah, definitely. Despite the benefits, the risks include, firstly, the size of the acquisition. Investors should be wary of large acquisitions, especially when the target company is financially unhealthy and or represents around 30% or more of the parent company. And this was the case with Ramelius Resources when they took over Spartan Resources, which was financially unhealthy. And this led to the removal of them as a star growth stock.
And we've got to be careful about what the earnings multiple paid and how that will impact capital efficiency measures of the combined entity. The higher the price paid, the lower the return on investment effectively. Therefore, investors should scrutinize the price paid to see whether it's reasonable. If you have the data, try to compare the price to the valuations of other similar businesses.
Meanwhile, also, Matt, you should also scrutinize management's motivation. As Charlie Munger once said, show me the incentive and I'll show you the outcome. Investors should figure out if management is incentivized by absolute metrics, like achieving a revenue or earnings growth target, which could be achieved easily through an acquisition.
And from a profitability perspective, it's important to assess the potential impact to the return on equity or the return on invested capital. Often with large acquisitions and equity raisings, these profitability metrics are diluted over time because of the number of shares having increased, meaning shareholders are receiving less return on their investment.
Yeah, definitely one to watch about the dilutions. And lastly, though, funding is another key factor to observe. If the deal is financed heavily by debt, or the target company is in a weak financial position, it could lead to increased insolvency risk. Take, for instance, when Slater and Gordon, when they acquired UK litigation business Quindale in 2015, the business faced significant losses from restructuring before, luckily, it was acquired by private equity. Well, that's all we have time for today. And thanks, Matt, for coming along. I know you've been very busy with all that gold activity, especially across the managed funds.
Yeah, it's a fairly typical March for us, isn't it, Ken? But it was my pleasure to be joining you. And if you do have any questions, please join us for Lincoln Live on Monday morning.
Yeah, thanks for that, Matt. And although M&A activity that can lead to significant short-term gains, it's important for investors not to, speculate too much, rather focus on the fundamental quality of businesses. Not only do these businesses, they generate sustainable returns over the long term, but many of them can be quite attractive to potential buyers if there is inherent value in the share price. For now, take care and have a happy, healthy, and prosperous week ahead.